What led to the 2008 financial crisis? To answer that, we need to go back to the 1980s and look at some key policy changes. In the 1980s, the financial markets underwent a seismic shift. Regulatory walls that once held firm began to crumble. Key among these changes was the repeal of the Glass-Steagall Act, a piece of legislation enacted during the Great Depression to keep commercial and investment banking separate. With its repeal, banks could now freely gamble with depositors' money, taking bigger and riskier bets. As regulations loosened, a new form of lending rose to prominence, the subprime mortgage. These were loans offered to borrowers with poor credit who, under normal circumstances, would be considered high risk. Banks, however, saw an opportunity to profit from high interest rates. But there was a catch. These loans were risky and banks needed a way to offload that risk. Enter the originate-to-distribute model. Banks would originate these risky loans, then sell them off to investors, effectively distributing the risk. But how could they make these risky assets attractive to investors? This is where things get really complicated. Banks bundled these subprime mortgages into complex financial instruments known as collateralized debt obligations, or CDOs. Even riskier were synthetic CDOs, which were essentially bets on the performance of the original CDOs. These instruments were so complex, even the people selling them didn't fully understand them. They spread risk throughout the financial system, and in doing so, they also hid it. One company, AIG, played a crucial role in this story. They ensured these risky investments, giving investors a false sense of security. But when the tide turned, AIG found themselves on the hook for billions of dollars they couldn't pay. These factors set the stage for a financial disaster, but the worst was yet to come. With these new financial tools and lack of regulation, the stage was set for a housing bubble of historic proportions. The early years of the 21st century saw an unprecedented rise in housing prices. Fueled by speculation and the belief in continuous growth, the real estate market seemed to be on an unstoppable upward trajectory. Investors and homeowners alike bought into the dream of incessantly appreciating property values. This period of inflated property values was not a reflection of the economy's health, but rather a symptom of speculative excess. Easy credit was another critical factor that contributed to the housing bubble. Low interest rates and relaxed lending standards led to widespread overborrowing. Lenders, driven by the desire for profit, started offering loans with minimal checks and balances. The infamous no-doc or liar loans emerged, where lenders did not verify borrowers' income or assets. People who previously had no access to credit found themselves able to buy homes, often ones they could not truly afford. Behind the facade of surging property prices and easy credit, the economy seemed to be booming. New homes were being built at a rapid pace, and the construction sector was thriving. The financial sector, too, was booming, with profits from the sale of mortgage-backed securities and other complex financial instruments. However, this apparent prosperity was an illusion. The reality was that the economy was built on a mountain of unsustainable debt. Borrowers were overextended, and the financial sector was heavily exposed to the risk of loan defaults. The complex web of financial instruments tied to mortgages masked the true extent of the risk. The housing market, and by extension the economy, was like a house of cards, ready to collapse at the slightest disturbance. This was the housing bubble of the early 21st century, an era of inflated home values, easy credit, and an economy built on unsustainable debt, a time of apparent prosperity, but with a ticking time bomb at its foundation. But like all bubbles, it was bound to burst. And burst it did. The fallout was swift and devastating. As interest rates began to climb, mortgage defaults quickly followed suit, particularly among those subprime borrowers who were least equipped to handle such financial strain. The dominoes began to fall. Banks and financial institutions, largely unprepared for the sudden shift, found themselves on the precipice of disaster. The housing market, once a booming sector of the economy, was now a sinking ship, dragging down anyone and anything in its path. As home values plummeted, the complex financial instruments tied to these mortgages also began to lose their value. Bear Stearns, a global investment bank and securities trading and brokerage firm, was one of the first to feel the impact. Massive losses loomed, threatening to topple the once mighty institution. But they were not alone in their struggle. Lehman Brothers, a venerable name in finance, also found themselves ensnared in the crisis. The losses were too great, pushing them into bankruptcy and sending shockwaves through the global financial system. The panic was contagious. Fear gripped investors around the world, leading to a widespread sell-off and further depressing market values. The credit markets, the lifeblood of the global economy, froze up. Banks and financial institutions, unsure of the extent of the losses and the solvency of their peers, stopped lending to each other. This credit crunch, in turn, choked off lending to businesses and consumers alike. Without access to credit, businesses found it difficult to operate, leading to layoffs and further depressing consumer spending. The global economy was now in a tailspin. The world was facing a recession, the likes of which had not been seen since the Great Depression. It was a stark reminder of the interconnectedness of the global financial system and the domino effect that can occur when one piece of the puzzle falls out of place. The 2008 financial crisis was a painful lesson in the dangers of deregulation and financial risk. The world had been given a harsh lesson in the cost of unchecked growth and risk-taking. It was a wake-up call that would shape financial regulations and the global economy for years to come. The aftermath of the 2008 financial crisis was felt worldwide, with millions losing their homes and jobs. This was not just a crisis of financial institutions and markets, it was a crisis that reached into the lives of ordinary people, their homes, their workplaces, their dreams. The economic shockwave was brutal and swift, leaving in its wake a trail of unemployment, bankruptcies and foreclosures. Pension plans, once considered safe, were decimated. Savings that had been painstakingly built up over years vanished as stock markets plummeted. The crisis also exposed the stark reality of income inequality, with the poor and middle class bearing the brunt of the fallout. At the same time, the crisis sparked a wave of innovation and reform. Governments around the world stepped in, launching unprecedented measures to stabilize the financial system. Central banks slashed interest rates to historic lows, and governments injected trillions of dollars into their economies. These measures, while controversial, were largely successful in preventing a complete financial meltdown. But the crisis also led to a rethink of financial regulation. In the United States, for example, the Dodd-Frank Act was passed, ushering in a new era of financial oversight. Around the world, regulators started to pay more attention to the shadow banking system and the risks posed by complex financial instruments. Yet despite these reforms, the scars of the crisis are still visible. Many people lost trust in financial institutions and the systems that were supposed to protect them. And while the economy has largely recovered, the memory of the crisis serves as a sobering reminder of what can go wrong. The 2008 financial crisis changed the world in profound ways. It reshaped our economies, our politics, and our societies. It taught us hard lessons about risk, responsibility, and the consequences of financial recklessness. The 2008 financial crisis was a wake-up call to the world, a stark reminder of the potential dangers lurking in our financial systems. So, what can we learn from the 2008 financial crisis? In the aftermath of the financial tsunami, we were left to grapple with some hard truths. For one, the allure of deregulation, the seemingly unending growth of the housing market, and the complexity of financial instruments all played a part in creating a perfect storm. The Glass-Steagall Act, once a safeguard against risky banking practices, was repealed, opening the door to an era of high-stakes gambling with our financial system. Banks, driven by the prospect of immense profits, began to engage in risky lending practices. They offered subprime mortgages to borrowers with shaky credit histories, only to bundle these risky loans into complex financial instruments called CDOs and synthetic CDOs. The house of cards was further propped up by inflated housing prices. Fueled by speculation and a false belief in perpetual growth, the housing market ballooned to unsustainable heights. Easy credit, low interest rates, and lax lending standards led to a borrowing frenzy. The economy appeared to be booming, but in reality it was precariously perched atop a mountain of debt. And then the inevitable happened. The bubble burst, triggering a cascade of failures. Banks faced massive losses, and some were even pushed into bankruptcy. The financial system teetered on the brink of collapse, and a global recession ensued. The lessons from the 2008 financial crisis are manifold. It underscored the importance of prudent regulation, transparency in financial dealings, and the danger of over-reliance on debt. It also highlighted the need for financial literacy among the public. Understanding how the financial system works and staying informed about economic matters can help us navigate the complexities of the economic landscape. Ultimately, the 2008 financial crisis was a wake-up call. It reminded us that unchecked speculation, irresponsible lending, and a lack of oversight can lead to catastrophic consequences. Understanding the past is key to navigating the future. The 2008 financial crisis is a stark reminder of that.